And that had consequences, which I shall explain in a second. But one of the consequences of the trade deficit was obviously that people in America consumed, and the trade deficit is, of course, the trade surplus of someone else. And so that someone else, to make it simple, was basically China. China began to supply the goods for the United States, so the exports from China to the US went up, industrial production in China went up, employment went up, wages went up, and so also as the exports kept on rising, what happened is that the entrepreneurs expanded capacities. In other words, capital spending also went up. So the factors, rising incomes, rising industrial production, and rising capital spending drove the demand for commodities to a higher level. It shifted the demand curve to the right, and this then resulted, obviously, in higher commodity prices. You can see here, these are the global expenditures for oil in the world. When the price of oil was at $10, global expenditures were $500 billion. Last year, at the peak, the annualized expenditures were $4 trillion. Now, at the beginning, I explained to you that the CRB had peaked out in 1980 and had been going down. In other words, 1980 to 2001, commodity prices go down. And so the resource producers of the world, whether it was the Middle East or Central Asia or Russia or the African raw material producers, all suffered because what they were selling was going down in price, but what they were buying was still going up in price. So we call that worsening terms of trade. What you sell is going down and what you buy is becoming more expensive. But after 2001 here, suddenly the resource producers of the world, and not just the oil producers, but also the producers of nickel and copper and wheat and corn and whatever, and precious metals, they had improving terms of trade. In other words, what they were selling was going up in price, and what they were buying wasn't really going up in price much. So they became very rich, and they went and spent money and bought goods, luxury goods, and consumer goods, and capital goods from Europe and from Japan. And that boosted economic activity in essentially Europe and in Japan, and then resulted in a global synchronized boom here. You can see that the world was growing very strongly in the period 2004 to 2007. And I would actually argue that in your lifetime you will never again see a synchronized boom. This was unique in the history of capitalism. Under colonialism, we never had synchronized growth in the world. And as you know, after 1945, when colonialism collapsed, 40% of the world's population came under communism and socialism and policies of isolation in India. Again, you didn't have a synchronized boom. And when communism began to break down at the beginning of the 80s, China was still small. And after 1980, as I told you, commodity prices went down. We had the petrodollar crisis in Latin America and so forth and so on. And so we never had this synchronized boom. By the way, there was just one country in recession in the last few years, and this was Zimbabwe, because it was run by Robert Mugabe, who is the mentor of Mr. Bernanke, a money printer as well. So all I want to say is money printing doesn't create any wealth. That you should rest assured. But I mean, this is very unusual, this synchronized growth, and we have to also see that we are in the world in a major transition. I mean, people say, well, I was lucky to come to Asia in 1973 and that there were lots of opportunities then, and today there are less opportunities. I disagree. I think that today we have much more opportunities in the world for investments because the world sphere has been enlarged through the breakdown of socialism and communism. But also what is happening here, you can see, these are motor vehicle sales in the world. For the first time ever, car sales in emerging economies are larger than in the industrialized countries of the world, including Japan. And I think this trend will continue. In China today, car sales are larger than in the United States. This is a major change in the economic geography of the world, because until recently people said, oh, the emerging economies, they never consume, they're small. Yeah, on a per capita basis, in emerging economies, we consume less than in the developed world. But because 80% of the world's population lives in emerging economies, in aggregate, the emerging economies have a higher demand in many markets than, say, the United States or Western Europe. Also, what has changed is the following. I mentioned earlier on that the US current account deficit went from $150 billion to $800 billion. So suddenly you have $800 billion flowing into the world from the United States, and that then leads to rising international reserves. Now the international reserves are at over $7 trillion, and 80% of these reserves are in emerging economies and Japan. So largely it's the poor world, including China and India and Russia and so forth, that have very large foreign exchange reserves, also Brazil. And then they lend it basically to the United States through the purchases of treasury securities. And obviously that is a huge change. Before, it was the rich countries of the world that financed economic development in poor countries. Now it's the poor countries of the world that essentially finance the United States. And therefore, I think that actually economically, the emerging economies are in a much better shape than actually the Western world. Much better shape, because they have the money. Now, I mentioned this fact that car sales in emerging economies are larger than in the developed world, but also other sectors of the economy are expanding in emerging economies much more than in the Western world. And this leads essentially to the world's GDP of the share of the developed countries in world's GDP is going down. In other words, it's not that the US and Western Europe is collapsing, they just don't grow much, and emerging economies are growing rapidly, so their share is increasing. And I think very soon emerging economies will be larger than the developed world in terms of economic development. And this is a major change in the sense that in the last 250 years, you can see here, the most developed countries increased their GDP per capita by 21 times in real terms. Whether it's 21 times or 20 times, I don't know. But basically they increased it much more than the developed world that had a real per capita increase of just 2.5 times. But I think going forward, it's the poor countries that will grow more. Where in China, as an example, per capita incomes have doubled every 10 years for the last 30 years. Or in Vietnam, India, you have a GDP per capita of just $800 per annum. It's probably quite easy to go to around $3,000–4,000 per capita income. Whereas in Western Europe and in the United States, you have high GDP per capita income. I think that there the progress will be very strong. I think this is a major reversal, that the share of world's GDP of the developed world is going to go down and emerging markets will go up and become more important. And I'm just mentioning this because this has an impact, obviously, on commodity prices, and it has also an impact on how you should invest your money. You shouldn't have a lot of money in the United States and in Western Europe. You should have essentially more than 50% of your money in emerging economies. By the way, as an aside, and I'm not here to talk about the prospects of Eastern European markets, but my view is that we've fallen very hard in Eastern European stock markets over the last 2 years. In Ukraine, here the index peaked out at 12,248. We went down to 3,366 on March 9 of this year. And I think this market has actually an upside potential of at least 30–40% from here. But long term, I don't know. I'm just saying for the next 3 months, this stock market has a good upside potential. But, and also the other Eastern European markets, because they haven't moved up strongly yet, whereas the Asian markets, the Latin American markets and so forth moved up very strongly already. But in essence, you should have your money in emerging economies and not in the developed world.